Amazon has just thrown a grenade into the traditional freight and logistics industry, announcing it will open its in-house trucking and freight capabilities to third-party shippers, a direct assault on incumbents who have long dominated this space. This is not a marginal product tweak. Amazon is leveraging infrastructure it already owns and has already paid for, meaning it can price freight services at marginal cost, while legacy carriers still carry the full burden of asset depreciation, driver costs, and fuel overhead. The structural implication is clear. If shippers migrate to Amazon's platform, volume and pricing power erode simultaneously for the incumbents. This is the kind of competitive shock that reprices an entire sector. Amazon confirmed it is expanding its logistics platform to offer third-party access to its proprietary trucking and freight capabilities, effectively entering the B2B logistics services market. This moves Amazon well beyond pure e-commerce fulfillment and into direct competition with established trucking operators and third-party logistics providers. The announcement sent shockwaves through the transportation sector, with JBHT Transport Services, SAIA, Old Dominion Freight Line, and XPO all in focus as the most directly exposed names. The broader market is holding relatively steady. The S&P 500 sits at 736.03, down just 0.14%, and the Nasdaq 100 at 706.71, off 0.16%, but the freight corridor is experiencing sharply concentrated selling pressure. The reason this announcement carries a structural weight rather than a cyclical one is cost architecture. Amazon has spent years and billions building out its own delivery and freight network to serve its core retail business. That infrastructure is already deployed and largely amortized into e-commerce operations. When Amazon prices freight services for third-party shippers, it is essentially monetizing spare capacity, meaning it does not need to earn a full return on capital the way JBHT Transport Services or Old Dominion Freight Line must. Legacy carriers cannot match that pricing without destroying their own margins. Wall Street has long anticipated this expansion, but execution risk around profitability of freight operations and competitive pricing remains a live debate. The direct blast radius includes JBHT Transport Services, SAIA, Old Dominion Freight Line, and XPO, all asset-heavy operators whose business models depend on sustained pricing power and volume commitments from shippers. If shippers migrate to Amazon's platform, these carriers face a double hit: lower volumes and compressed spot rates as Amazon's pricing sets a new ceiling. Regional 3PLs face a separate but equally serious threat. Shipper consolidation around Amazon's one-stop logistics offering could disintermediate them entirely. Meanwhile, Amazon itself stands to gain a new revenue stream with high incremental margins. The Russell 2000 is actually up 1.04% today, suggesting smaller freight names may be seeing tactical positioning rather than pure flight. The critical variable to track is adoption velocity, how quickly mid-market and enterprise shippers begin routing freight through Amazon's platform versus incumbents. If early contracts show favorable unit economics for Amazon, expect sustained pressure in JBHT Transport Services, SAIA, Old Dominion Freight Line, and XPO. On the macro side, interest rate levels matter here because logistics M&A appetite is directly rate sensitive. Higher rates make it harder for incumbents to lever up for defensive acquisitions. The VIX at 20.50 reflects elevated sector-specific volatility, and energy prices are an added margin headwind for asset-heavy carriers whose fuel cost exposure is already a pressure point going into the summer freight season. Amazon's move into third-party freight is not a pilot program. It is a structural repricing of the entire logistics value chain, using infrastructure costs that are already sunk. Asset-heavy trucking names like JBHT Transport Services, SAIA, and Old Dominion Freight Line face sustained margin compression and potential customer defection with no obvious short-term defense. XPO, as a 3PL with a broader service mix, may have more levers, but it is not immune. The playbook here is to reduce exposure to legacy freight operators and monitor Amazon's freight unit economics in upcoming earnings commentary for evidence of whether this is a sustainable competitive advantage or a near-term disruption play. That's the full picture on the Amazon freight story. Coming up, we turn to another market-moving development demanding close attention. And now we pivot from markets in motion to the number that is reshaping every trade on the board today. The Bureau of Labor Statistics just delivered a May CPI print that stopped the streak cold. Consumer prices rose 4.2% year over year, the hottest annual inflation reading in 3 full years. This was not a modest overshoot. It is a structural signal that price pressures are re-accelerating at exactly the moment the Fed needed proof of the opposite. Markets opened under immediate pressure, with the VIX jumping to 21.03 and the 10-year Treasury yield sitting at 4.53%. The inflation trade is back, and it is not subtle. Let's get precise about what the data actually says. May consumer prices rose 4.2% on an annual basis, a reading that consensus did not anticipate, and one that represents a meaningful inflection higher after months where the street was pricing in gradual disinflation. The prior trajectory had given markets confidence that the Federal Reserve might pivot toward rate cuts later this year. That thesis is now severely damaged. Bond markets reacted instantly. The 10-year Treasury yield sits at 4.53% this morning, and fixed income ETFs like long-term Treasuries and TLH are under direct pressure. The VIX climbed significantly to 21.03, confirming that options markets are repricing downside risk across the board right now. The deeper story here is not just one bad data point. It is what 4.2% annual CPI does to the Federal Reserve's entire forward guidance framework. The Fed has been threading a very narrow needle. Hold rates steady while signaling future cuts to keep equity markets supported and credit markets functioning. A 3-year high in consumer prices destroys that narrative entirely. Core CPI, which strips out food and energy, will be the critical subcomponent Fed officials scrutinize because it reflects underlying demand-side price momentum that monetary policy actually controls. If core is also elevated, the July FOMC meeting becomes a live hawkish event, not a passive hold, and that changes every duration calculation on Wall Street. The transmission mechanism from CPI to your portfolio runs through real interest rates and equity risk premiums, and today both are moving against growth. Long-term Treasuries and TLH face direct selling pressure as the 10-year yield at 4.53% could push toward the critical 4.6% breakout level that analysts are watching for a full hawkish repricing. Rate-sensitive mega-cap technology names are squarely in the crossfire. NVIDIA, Microsoft, and Apple all carry elevated valuation multiples that compress when real rates rise. The Nasdaq 100 is already down meaningfully. Meanwhile, the Russell 2000 is outperforming today as small caps with domestic revenue streams offer relative shelter from duration risk. 3 technical levels define the risk envelope for the next several sessions. First, the 10-year Treasury yield at 4.53%. A sustained break above 4.6% would confirm that bond markets are fully abandoning any rate cut pricing and force a broader equity derating. Second, the VIX is at 21.03 right now. A close above 22 has historically triggered systematic risk-off selling from volatility-targeting funds, amplifying drawdowns. Third, the S&P 500 is holding above the 7,300 psychological floor. A break below 7,250 would constitute a technical breakdown. Energy remains a relative bright spot, and gold bears watching as an inflation hedge after recent pullback. Here is your one actionable takeaway. With CPI printing at a 3-year high of 4.2%, the Federal Reserve's path to rate cuts is closed. The July FOMC meeting will almost certainly deliver a hold with hawkish language, and the era of easy multiple expansion for high-growth technology names is on pause. Rotate toward value, utilities, and real assets, sectors with pricing power and shorter duration profiles that outperform when real rates rise. Reduce exposure to long-duration fixed income like long-term Treasuries and high-multiple tech until the 10-year yield stabilizes. Those are the 2 stories driving markets today. The full breakdown is right here, and the data is telling you to position defensively now. If this kind of deep-dive market analysis helps you trade smarter, hit subscribe right now and tap the notification bell so you never miss a daily breakdown. Every morning we cut through the noise and give you the numbers, the levels, and the trades that matter. No fluff, just signal. We will see you tomorrow.